For more on the latest economic data and what it means for both the Fed and investors moving forward, let's welcome in Dan Skelly, Morgan Stanley Wealth Management Managing Director and Head of Market Research and Strategy Team. Thanks so much for being here. So, you heard what we were saying about PCE here, that the numbers today don't necessarily seem to disrupt the narrative on the part of the Fed that we're looking at perhaps a May or June rate cut. Was that sort of your reading as well, or are you still concerned and you're going to be watching the February numbers very closely as well?
Sure, and thanks, Julie, for having me on. It's great to be with you. So, look, I think as mentioned, it was pretty much in line today, and that was a relief as you're seeing in the market at the moment after what had been hot CPI and PPI, throwing a little bit of cold water on this idea of disinflationary growth, which had been the trend for a while. But I think importantly, Morgan Stanley as a whole, and Ellen Bettner, in terms of our chief economist, has been expecting June for the first kickoff day in rate cuts for a while. We think the market was ahead of its skis. Back on Jan 1st, you were basically 100% priced for a March cut, and we thought that the first couple of months of this year would present a more lumpy set of inflation data, and that's just what we've gotten. So today is a bit of a relief to see that we're still probably on our way towards mid-year for cuts. By the way, that's where the market is really coalescing as well. And I would just lastly say, Julie, that the idea whether or not from here, if we have 3 or 4 or 3 or 2, is probably much less impactful. I think it's actually a very healthy sign that we went from pricing 6 to 7 to closer to 4, and that wasn't disruptive at all to the market.
And Dan, I'm interested in switching gears here. So that's the Fed. Let's talk earnings as well, Dan, because we're obviously winding down the earnings season here. You got some prints after the close, Dell, HPE today. But Dan, I'm just interested to get your take on the earnings season. What did you learn, Dan? What were the big takeaways for you?
Yeah, excellent question, Josh. So a couple things. First, we saw in really the last week or so, as big cap tech reported, the skew in terms of an overall positive healthy earnings picture is actually improving. So you're going to look at maybe +5, +6% overall earnings growth for 4Q23, which is, I think, helping support the idea that the earnings recession is over. We had 3 quarters in a row of earnings declines last year, as you know. And so I think we're finally starting to see, an overall pickup, of course, again, led by big tech. And frankly, a lot of the revisions that we're seeing are from some of the same revisions winners from last year. And so the big question, Josh, is when does the rest of the market, right, the S&P 493, start to see their earnings improve? And I think it's a function of 2 things. First, I think it's this idea whether or not the top line and the revenues can sustain, and that's going to be dependent on the economy. Overall, the economic rates have been positive, as we've talked about. But more importantly, I want to introduce the concept of not just Magnificent 7 or 493. I think it's all about what the Fortune 100 does with AI. And what we're hearing from a lot of companies, a lot of industries, is that the second half of this year is the window to start to more tangibly quantify how much AI projects may impact the revenues and the earnings power of other industries. And so that could be something to watch later this year.
Dan, it's really interesting that you bring that up, because we're coming off a week in which, Google in particular was under scrutiny because, well, their AI was making some mistakes, right? And so it also raises some questions about the time frame that people are looking for this stuff to make a real tangible difference, as you say, a real tangible monetizable difference also, by the way, right? So I just wonder what you're looking for in terms of where we're going to see that really start to bear fruit.
Yeah, really interesting question. So a couple things. First, we do pretty broad-based survey work at Morgan Stanley Research, and a couple of really notable things stood out in the most recent 4Q survey. So number one, the survey said that AI as a spending priority is number one for the first time in that survey, something like decade-long lifespan. Number two, the time frame, or again, the window for which many companies surveyed are saying that the AI projects or the AI initiatives are actually going to impact their productivity or revenues is actually in the second half of this year, early 25. And I guess the very last thing I would say now is just kind of unpacking AI and generative AI. which is truly the newest phenomenon as of the past year, versus other uses of industrial technology. And this is important because the other uses of industrial technology has to do with this concept of tech diffusion and big data and the data era leadership. These are themes Morgan Stanley has been writing on for literally 7 years. And so while AI and generative AI had its kind of big aha moment last year, some of these underlying themes are also starting to permeate the rest of these industries. And so I think that's important to watch too. It's not just going to be generative AI. It's going to be the idea that the intersection today between companies emerging from an earnings recession and having more capital on hand, the fiscal initiatives that are being led by the government that are very much infrastructure and tech and renewable related, intersecting with certain companies' revenue streams as well. It's really, again, the intersection of all these different trends coming together today where, we do think it will be impactful later this year.
Dan, I'll get you out of here on this. Major averages on track here, Dan, for their fourth straight month of gains here. I'm interested to get your take on valuation. And I asked Dan, because we had some strategists on this week on the show who said, to their eye, valuation is actually looking maybe a bit rich here. What do you think?
Valuation is certainly fair when you look at the S&P 500 level. You consider the fact that we're trading around 20 times forward earnings. We personally think that the market should trade at a higher multiple sustainably because the mix of the composition of the market has improved over time towards a higher growth, higher quality, less debt skewed type sector, again, with a lot of that emanating from tech. So we think it deserves to trade at a higher multiple. I think, again, the macro backdrop has implied that the lion's share of the rate move from 5 to 4 from last summer to now, particularly given Powell alluding to rate cuts in December and the market being more 100% priced for middle of this year rate cuts, I think the lion's share of the multiple expansion has happened from rates, giving you a tailwind. And so again, Josh, the question comes down to where does the multiple where does the multiple level out? And this is where the upside, again, could be based on a couple of things other than fundamentals. And I'll just quickly go through them. So there has been hand-wringing over the election. I think it sort of remains to be seen, obviously, how we get there and what happens. There's a lot of uncertainty. But notably, this is one of the only elections in history where both candidates have been in the White House prior. And in both instances, Biden and Trump, you saw pretty benign markets and economy. And so maybe the election just proves to be a nothing burger. You've seen, obviously, a ton of flows into money markets, chasing yield. And again, if the Fed is cutting, I think those weaker hands may acquiesce to equities in the form of more aggressive flows later this year. So again, the question is, aside from rates and earnings and fundamentals, do you get a little bit more multiple expansion this year simply from hotter flows and from some of these other kind of intangibles fading away? It's certainly possible.
Dan, you gave us a lot to think about and chew over. Thanks so much for joining us and helping us kick off the show today.
Thank you very much.